Let's finish up chapter 11. The thing we'll start with is special order decisions, and that's on page 415. And the example they'll walk you through on the screen is exactly the same information on page 415. And a special order decision is basically a customer comes to us and says, we're going to kind of offer you a deal. If you make us this item and only charges X dollars per item, would you do it for us? Kind of a one-time deal. And so a firm has an opportunity to sell a quantity of product or service, typically to a customer who's maybe not a regular customer or just needs something done special. And doesn't happen very often, non-recurring. And so in this example, we have a shirt company, TTS, that charges $9 per t-shirt. Okay, but a fraternity has come to them, Alpha Beta Gamma, ABG, and said, you know what, instead of paying you $9 for a shirt, what if you do the special order for us? We need 1,000 shirts, and we'll pay you $6.50 per shirt. And so would you do it? And so the next question then becomes, what are the relevant costs in doing this? So, would it make sense for TTS to undertake this or not? Now, one key thing that they mention in the setup of the problem on page 415 is the fact that TTS has a capacity of 250,000 shirts. And right now they produce 200,000 units. So they have capacity. They've got a $50,000 unit excess capacity the way it stands right now. So we take a look at this particular situation. Should they do the special order or not? And that cost per unit is just given to us. It's basically what it costs TTS to make a shirt. They have to buy a shirt from a supplier. They have ink they have to buy. They have somebody operating the machinery. And so a cost per unit is 505. And they typically do these shirts in batches of roughly 1,000 shirts. And so for each batch, there's a setup cost, an inspection cost, a handling cost, and that comes out to be $200 of batch level cost. They of course have fixed costs that they're going to incur no matter how many shirts they make. And you can see what those are in terms of setup, inspection, and materials handling. They also have some facilities level fixed cost, machine related and other. And so their total cost is 405. And you can just kind of see then cost per unit to make a shirt, a batch cost, and so on. So the next thing that comes into mind then is what are the relevant costs? And so if they're going to make 1,000 shirts extra above and beyond the 200,000 they're normally going to make, we have to look at the variable cost to make a shirt. $3.25 to buy the shirt, 95 cents in ink, 85 cents per shirt for the labor. And then of course the batch level, this is another batch to run through, which is $200 in total, which would be 20 cents per shirt. So the relevant cost is $5.25. So if TTS was to make this batch of 1,000 shirts, they'd spend $5,250 to make them, or $5.25 per shirt. And so you can just basically say, well, if this company is willing to pay us $6.50 to make these shirts, then it's probably worth doing. And so what they're saying with this slide is anything that's not relevant is what's on this slide, which is all the fixed cost. They had fixed setup, fixed inspection, fixed materials, and then the big facilities, fixed cost, machine related and other. Those don't change if we make 200,000 shirts or 201,000 shirts. So those are not relevant. They do not change if we take on the special order. And so this really then is the comparison of if this makes sense or not, and the fact that if we do this, we'll make $6,500 in sales. We'll have cost of $5,250 above and beyond the cost you already have. So basically we'll make $1.25 per shirt. Okay. So the key here though is they have the extra capacity. So it does make sense from that perspective of they have the capacity. It would not affect fixed cost. They're not giving up the opportunity to make 1,000 shirts for somebody else who will pay them more than $650 per shirt. And so under those circumstances, it probably makes sense to do it. However, and that's what the next slide's about, and that's what page 416 of your book will describe, basically towards the bottom of the page, bottom of page 416, okay? TTS needs to consider the strategy, okay, the long-term factors. They can't just look at the short term and go, we're going to make an extra 1,250 if we do this. We have to think about some other things, okay? Capacity, in this case, are not near full capacity. They're not giving up the opportunity to make shirts that they could make more money off of. This is just, this is for now, all that we know is it's a special one-time order. But that's part of the key too, is this really a one-time special order, or will this particular customer always expect to come to us and only have to pay $650 per shirt when we're charging everybody else more than $9 per shirt, okay? So that's a key factor also. Credit history of the buyer. Basically, do we anticipate that we will receive our payment? We don't want to do the special order, incur these extra costs, and not get paid. So maybe we would just demand payment up front before we make the order, just to make sure we're going to get our profit out of it. And then the bottom line here too is, will this affect long-term price structure? If other customers get wind of this, will they demand that they pay less than the $9.25 per shirt they've been paying, and would they expect a price closer to $650? And that's just not going to work for our company. We're not going to have our needed gross margins to be able to be profitable. So all those qualitative things to think about when it comes to analyzing one of these decisions. So to quantify the decision, we go, yeah, it makes sense to do it. But if you add the qualitative factors, it may or may not make sense to do it. We don't know the answers to those questions, but just things that management would have to think about before they decide to take on this special order. So the next one we can take a look at then is make or buy, and that's on page 418. Make or buy. So an example they're giving us, we've got a make or buy. Should we make some parts internally, and which parts to purchase from an outside supplier? Okay, so what parts should we make versus what parts should be bought from somebody else? Okay, and the example they gave us is Blue Tone Manufacturing, which is making clarinets and other reed-based musical instruments. So anything that has a reed in it, those kind of instruments are what they're making. And of course, the strategy is they're known as being high quality. They make a very fine product, and they're trying to figure out, with all the parts to make a clarinet, should they manufacture all the parts, or should they consider outsourcing the mouthpiece in particular. They have the option to buy that from a supplier, but a key thing here, it says fixed overhead costs will not change whether they choose to make or buy the mouthpiece. So even if they choose to go and buy it from somebody else, they're not getting rid of fixed costs in this analysis and the assumption that we've been given. And so with the make or buy decision, then they're showing us a whole bunch of numbers, and they show us these numbers from the bottom of page 418. The cost of a mouthpiece, the cost to buy is 24. The cost to manufacture it is right here. Basically, materials is 16, labor of 450, some variable overhead of $1. So variable overhead's 21.50. The fixed cost, though, is not going to change, right? Even if we buy these for $24 from somebody else, we still incur the fixed cost. So the total cost to manufacture is $27.50, but the relevant cost is actually $21.50, which is just all the variable cost. And so the per unit savings is $2.50. And the reason it's a savings is because we cannot eliminate the fixed cost, and so what's relevant is just variable, and our variable cost is less than the cost to go out and buy it. Okay, so per unit savings from continuing to make it. And so it still makes sense in this example to still potentially just make it. Okay, so basically we're saying that manufacturing is more cost effective. And if we were able to eliminate the fixed cost, then what's relevant is $27.50, and $24 obviously is less than $27.50. And in that consideration, we would think about going out and buying it. However, we still have to take into consideration the strategy. Okay, the quality of the part, the reliability of the supplier. Another key thing then is the opportunity cost. If we give up the making of this mouthpiece, can we do something else with that manufacturing capacity? So the people or equipment that was making the mouthpiece, can it be used for something else? Okay, so all those things have to come into play to make a decision. You can't just focus on the numbers. You have to think about the strategies underlying the numbers also to make that decision. Page 419 is the lease or buy example. Should we lease a copier or go out and buy a copier? And that's the example they're giving us here. So we have a printing company called Quick Copy, and they have a very large, big old fancy copier slash printer, a big machine that they use primarily for the business. And they're considering an upgrade to the latest model of copier. But the manufacturer is basically saying it's not available to lease. If you want it, you have to actually just buy it. And the purchase copier is useful for a year. And then after that 1 year, we're going to spend $160 to buy it. And then the manufacturer is saying that they will guarantee a $40,000 sellback after that 1 year. So because we've got this, high quality print shop and we need to make sure we always have the highest quality of prints, we're going to just use the machine for a year, sell it back, and then we'll make a decision if we lease or buy another one. So just in this 1 year, that's our focus for our discussion or our decision here, is in this 1 year, what do we do? So in addition, the new machine has a required annual contract of $20,000. So we're buying it for $160. We also have to buy the service contract for $20, and then we sell back the machine for $40 after the 1 year. So basically the question then is, should they buy the new machine, which is the latest, greatest new technology, or do they just continue leasing the copier that they have right now? And they run these numbers for us on the bottom of page 419. And so Quick Copy, lease or buy. So if I lease it, the lease price is $40,000 per year. Obviously, if I'm purchasing it, I'm not leasing it. If I lease it, I also pay 0.02 cents per copy to the leasing company. If I purchase it, I spend $160. I have to buy the contract for $20. But then, of course, I've got that residual value at the end. And either situation with either the leased machine or the new machine that I would buy, I'm going to make 6 million copies of material. That's basically what my run rate is with my business, is I expect to produce 6 million pieces of copies or printed material during the year. And so what they're going to do here then is kind of just show us a formula. The same formula is on the bottom of page 419, lease versus purchase. And so with the lease cost, we're looking at the annual fee, which is $40,000 plus 0.02 times Q for quantity. And what we're trying to find is what they call the indifference point, and the point at which it makes sense to do either one. And then we're going to compare the indifference point to the expected actual usage, and that's what will help us decide which one to do. Okay. So the annual fee is the $40,000 lease plus 0.02 cents times whatever that quantity of indifference is, equals the purchase cost of $160 minus the residual value of $40 plus the service fee. Okay, so of course that it turns out to be $140 on the right side. And we can simplify this to say that the 140 on the right side minus the 40 on the left side is 100,000. Okay, that's how I get the 100,000 divided by the 0.02 over here. So Q equals 100,000 divided by 0.02, which is 5 million copies. So the indifference point is 5 million copies, which is 1 million less than the expected annual usage. And so what they're saying then, it makes more sense to purchase the machine, okay? Assuming that the strategy still makes sense in terms of quality of the copy is still there, reliability of the machine is still there, and the benefits, features of this contract are still favorable. So does the service contract protect us? Does it give us the ability to get the machine fixed if it breaks down, and some things like that? And they kind of graph the indifference point right here. And because basically the cost to lease the copier, the more copies we make, it becomes more expensive because we've got the 0.02 cents times every copy we make. Whereas with the purchase, we're just out a fixed number of dollars. It doesn't change. And so that indifference point is 5 million, but the run rate's going to be 6 million. And so that gap right here really basically says we should purchase it instead of leasing it, assuming everything else will work out okay. Another example we can take a look at is on 421, which is should we sell before or after additional processing for something that we manufacture. Okay, so sell or process further. And we're going to go back to our t-shirt company, TTS, and we need to decide if we should sell a product or service before an intermediate processing step, or do we add further processing and then sell a product or service for a higher price. Okay, and so in this example, TTS has suffered an equipment malfunction while we were running a batch of shirts through our equipment, and 400 shirts turned out to be unacceptable. Okay, they cannot be sold to whoever was going to buy them. We can sell them though as is to a discount store for $4.50. Okay, or we can run them through again, which means incurring some additional cost, and then sell them at their normal full price. And so the cost of rerunning them through our printer is a variable cost of $1.80, which is mostly the setup, the extra ink, and the extra labor. Okay, so we can sell them. They're not of high quality. We can't sell them to our normal buyer, but we can sell them to somebody else, a discount store, for a much lower price, or we can fix them and incur some higher cost per unit and sell them at full price. And so, of course, it's always a matter of what's relevant. So our normal selling price is $9 per shirt. And so if we reprint them, our revenue is $3,600. If I sell them as is, I can just sell them for $4.50 to somebody else and make $1,800 in revenue. And so basically I can sell them as is for $1,800, or I can sell them for $3,600 and then incur all those variable costs, the relevant costs, to fix them, which is $1.80 plus the setup cost. Okay, so $1.80 is 95 cents for supplies and ink, and 85 cents for labor. That's my $1.80. The sum of those two, my setup cost of $200, and so my relevant cost is the $380, the $340, and the $200 add up to be $920. So $3,600 minus my relevant cost equals my contribution margin, $2,680. And so because that's way higher, $880 higher than selling as is, it obviously would make a lot of sense then to run it through and sell it for the higher price. Okay, now that's a no-brainer. That's obviously what we should do, right? However, let's say the numbers turned out to be almost the same, or let's say that the reprint was lower than the sell as is. The strategy there would then be, if we sell our shirts to a discount store, and think of a dollar store or a lower quality store, and we sell our shirts to that store, and our name brand is on these shirts, are we negatively impacting our brand? Okay, that would be one thing to consider. Are we willing to sell an inferior product and get it out in the marketplace and have people think that represents our quality? So that would be a strategy to think about. The next thing we can talk about is profitability analysis, and that's on page 423. Should we basically drop a product or a service line? And we're going to try to figure out which product lines or which service lines are most profitable. Are we pricing our products appropriately? Should some products be promoted or advertised more aggressively than others? Should some product line managers be rewarded for achieving certain goals? And so the example that they're giving us is we've got a company that makes windbreakers, and they manufacture 3 models of jackets, and they're considering dropping their lowest profitability product line, which is the Gale jacket. Okay, they're thinking about just dropping that. And the key, though, is if they drop Gale, there'll be no change in total fixed cost for the upcoming year. Okay, and I've mentioned that before. This chapter really focuses mostly on the short term, which is 1 year or less. In the short term, it's hard to change fixed cost. Okay, long term, all fixed costs can be changed, but typically fixed costs are tied to long-term contracts, machinery we've purchased that we're still financing, and we have to repay bank loans or lease payments. And we've got contracts that are signed that we can't just back out of in a year or less. You know, we can begin to negotiate and change our cost structure, obviously, but those things take time. Okay, so here's how they are as is, page 423. Okay, at the top of the page, Exhibit 11.13, Calm, Windy, and Gale are the 3 product lines. You can see the units sold, the revenue for each line, the price for each jacket, the variable cost, contribution margin, and then fixed cost. You can see the operating profit per unit. You can see that Gale has a very low operating profit per unit. And so that, of course, is why they're thinking of dropping that particular product line. And so then on the bottom of page 423, they show us a Exhibit 11.14, a contribution margin income statement where Gale is dropped. And that's what you see here, the top screen right here. So here's what our numbers would look like if Gale is dropped. Our sales minus the variable cost minus the fixed cost, which doesn't change. Remember that if I go back to the previous screen, fixed cost is 171, and it's still 171 right here. We said that fixed cost will not change if we dump Gale. Okay, and so I get to a profit of 129. Compared to if I keep Gale, my profits are 144. And the key reason for that is even though Gale was my lowest money maker, it still at least contributed $15,000 to paying off my fixed cost. And that's really the difference between these two is 129 versus 144. The difference is 15,000 because I lost Gale's $15,000 contribution to paying for fixed cost. Now it's gone. So from this perspective of I cannot change fixed cost, it makes sense to keep Gale and at least contribute something to paying for fixed costs. It's not losing money, it's not making much money, but at least it's helping pay for some of those fixed costs. So if you're really thinking of dumping Gale, we really got to be thinking about how do I also avoid those fixed costs. So that's the strategy manager really should be thinking about then is how do we start planning today to eliminate those fixed costs, and by the time we get those lowered, can we then dump Gale? And so can we reduce fixed costs more than the $15,000 contribution margin we're getting from Gale? Then it would make sense to drop that product line. Okay, so that $15,000 is really the difference between the two. Okay, and of course, if we're dropping a product line, there's all the qualitative factors to think about. If we drop a product line, would that affect sales of the other lines? Would it affect the name of our brand? Or would it affect company morale who are affected by the decision? Those employees who are negatively impacted? Will that affect the morale of people who are still around, and so on? Okay. I'm skipping quite a bit here, and I'm going to move on from the profitability line analysis to page 429. And 429 covers, got to get to the right screen here. I'm skipping quite a bit, and of course, whatever I'm skipping, I'm not going to quiz you on or test you on. And so we're going to go to page 429, and we're going to talk about the behavioral and implementation issues associated with decision making. Okay. Of course, I've been emphasizing that a company's strategy has to be at the forefront of any decisions made. Okay, that absolutely has to be number one. We also have to be concerned about predatory pricing, and they've mentioned that really about the middle of page 429. And that's when a company sets prices below its average variable cost. Okay, so basically they're losing money or not making much money to get market share or to get customers, but then they raise prices later to recover losses. Okay, and they raise prices after they've knocked out the competition. So they're willing to take short-term losses, make the competition either bail out of the market or go bankrupt. And then once they gain market share, now you jack up the prices. So you can see why there's laws against such things, because it goes against free market, fair trade, and it negatively impacts customers who, we all benefit when there's competition. And that means we get the best price, hopefully the best quality. So predatory pricing kind of undermines that. And so they mention quite a bit about that on page 429. And they give a couple of examples. They talk about American Airlines and a couple of other things. And basically they also mention that anytime the government has brought one of these cases to court, the government's always won. Okay, so companies who've done this have always lost. So it's not a smart thing to do from a legal standpoint. And then the other thing I want to talk about is management's goals. Okay, so the goal of management in making these decisions should be to maximize contribution margin. Remember, that's sales minus variable cost. Okay, so you want to maximize that while keeping fixed costs as low as possible. Okay, because relevant cost analysis focuses on variable cost, and for the most part ignores the fixed costs because typically those don't change, because we're thinking short term, typically 1 year or less. And so what's relevant in 1 year or less typically is the variable cost. The fixed costs are hard to change in the short term. Okay. If upper management, though, focuses too much on variable cost, there's a danger lower level management may feel pressure to replace variable cost with fixed cost at a long-term expense. Okay, so you have to keep a balance. You have to make sure that top management isn't giving out the wrong rewards to middle or lower management also. Okay. And also management must be careful not to include irrelevant sunk costs in their decision making. Okay. You want to focus on what's relevant and what will change if we choose two different paths or two different decisions. Okay, that's it for the chapter. Thanks for listening.